Hello, Warriors. How's everyone doing today? Hi, Phil, Shahab. Everyone doing okay? All good? Yeah, thanks. Good. All right. So I want to start off with US dollar yen. I think there's a decent possibility that this is my view that we bottomed last week. Again, there were, a couple little head fakes here and then looked like a breakdown. Now we're back above it. Also, this pullback that we have here, right just a little bit under 50%, not quite to 61.8, would have been 105.19. And if you look at this, and I know a lot of people are saying it's pretty boring while why traded, but this was pretty directional. Oh, thank you, Ziggy. Actually, she's home. She was released. So her voice sounded strong, so appreciate that. So I'm thinking at least we have at least 108 in here. And why can't we have something like this from in here, that this could have just been corrective? I know a lot of people are bearish this pair, flight to quality. It didn't do much with risk on with the whole recovery in the S&Ps. But I'm guessing that there's going to be a reconnection of this correlation, US dollar yen, with yields. Okay, so I want you to look at this chart right here, TLT. So, it's a pretty lonely contrarian type position to be looking for higher yields. I know Stella is through the Bunds. I have been for a while, and all we've been doing is moving sideways, but I want you to take a look at this TLT chart right here. We haven't opened. It'll open with stock indexes. But I think as US dollar yen rallies, advances, that yields will head up, which means TLT will head down. And right now, to me, this looks like Wile E. Coyote standing on a ledge supported by the 61.8 level and the 50-day moving average. So to me, unless the Fed, they say don't fight the Fed, that's another reason people aren't shorting treasuries. I think it's ready to give. And, we don't have to have something like this, but why can't we correct this advance, pull back towards 154 or so? And that's going to tie in with the correlation of US dollar yen advancing. I wouldn't just chase the yen here. In fact, what could end up happening is maybe we get some type of right shoulder on the yen. Looking at the 2-hour, left shoulder, head, rallying to a neckline. Let's put the neckline here. Hello, Varun. I'll let the other guys talk about cable, but let's just do this. Something like this. Not that today's early session high is anything significant, but maybe it is. And maybe you get some type of pullback, all the way down to here even. But a breakout from here is going to look like 108.80. And I just can't ignore the bull case of this being a flagpole and this being corrective, correcting this overbought position in time, and the potential of yields heading up, which is what's also pressuring S&Ps. They sold them Friday. It was underwater. Here's a couple areas to watch, and we're at one of them right now. All right, see this top here, this top here. So, and look at how this moving average comes in here. Today, I'd call this pretty important. If we start closing under the 2,900 level, I think that's going to be, a pretty good indication that we have a failing rally and we're not going to take this top out, but it's early in the session. And then you have all kinds of levels, then you're going to have this level down here, and this could be real critical. So, let's just guess 2950 and call this 2770 the low of the break from 61.8. Call it 180. 180 from here is going to get you about 2580, and I'm seeing a lot of people talking about this 2500 26 level. So here again is reasons on the 4 hour. So we could be rolling over. There's your daily. It's going to take a lot to get a weekly reversal, but it's early in the week. For us to have a 2-week reversal, we need closes by Friday 28:30. And then I just wanted to wrap it up with gold, because we have a pretty unusual situation happening here in gold. Okay, of course we have this triangle that it respected here earlier last week, and then this was Friday, couldn't get through it. But what's even more interesting to me, and this could be a great candidate for volatility spreads. It's an $80 formation, so classical technical analysis will say breakout over 1720 gives you 1800. Failure under 1670 gives you 1600 down here. Okay, but what's really interesting about this, and you rarely see it, is since the high that we had over a month ago, see this range? The following week was inside of that range. The next week was inside of that range. So you have a double inside week going into this week. So we'll see what happens on a breakout. Actually, I'm thinking that the first breakout might be the fake out, but we'll see. A guess right here is that's all it is. That's why option traders would buy a put, buy a call, knowing that whichever way it comes out, the winning side of the trade is going to compensate for the losing side of the trade. Okay, any questions before I turn it over to Blake? My screen is blinking. Okay. Maybe you're having flashbacks. Okay, I'm going to let the rest of the team talk about it. The one thing I could say about CAD last week. Oh, I just coattail everything you do, FX trader. In fact, you know what? I can retire after your comments from the peanut gallery. I mean, how do I get in your hedge fund? Anyone know how to get in there? Just one more thing about Canada is, let's see, I may have had this line drawn wrong. Maybe I'll move it to here. But we're in a pretty critical level here too. So 38.5, and then above last week's highs look like important pivots on that. And with that being said, Blake and I must be kindred spirits. I was staring at the clock at 1:30 in the morning. There's nothing more anxiety prone than knowing you have to get up in a few hours and you're still awake. Right, Blake? I mean, what? You stare at the clock and go, oh, shoot, I only could have 3 hours.
Very true. Very true. That happened to me last night. I didn't get much sleep. I'm just so yesterday, for those of you that didn't know, yesterday was Mother's Day here in the United States. Observed.
Yeah, those of you that have been cloned. Oh, you're right. It's only an American holiday.
Yeah. I mean, I don't think it's Mother's Day observed everywhere, but in the United States it is.
Those mothers.
And so us us dads
I'm punchy.
cooked.
Yeah. Go ahead.
Actually, just myself and my brother-in-law. Yeah, we cooked, and needless to say, I
You
had an
cooked.
upset stomach all night, so I didn't sleep too well. Um,
That Louisiana hot sauce, man.
yeah. So I did what you did. It was midnight
Yeah.
last night. I was looking at my alarm saying I'm gonna have to get up in a couple hours, and that's not gonna
Yeah.
be good. So I'm a little tired. A little tired this morning, but
Come on, Marine.
yeah, just I'm tired. Can't really cure that.
Yeah.
So we're seeing a little bit of risk off. We're seeing the stock market come off a little bit, and actually, um, uh, just moments ago, crude oil started to rip back a little bit as we had Saudi Arabia decide they want to cut output unilaterally by extra 1 million barrels per day for June, which isn't all that much. I mean, but crude did bounce as a result into positive territory. So has that helped stabilize the equity markets at this point? Maybe, but I guess you have to think about where the S&P really just stopped. So this is pretty important support. You can see it right here. Remember, this is our previous that head and shoulder that we were looking at. That was the previous shoulder that we were looking at. So now we're just pivoting on that breakout point. And I think this is pretty important for bulls too, as far as the stock market goes, because we just flushed through that hourly low, and then we're finally getting a foothold here. So I think that this is just, excuse me, this is just a pullback for right now. Let's see if it coincides with any fibs. And like I said, I'm moving a little slow this morning, so bear with me. Yeah, we're just below that 38% retracement. And so if the stock market does find some support at these levels, which I think it will, you probably see a snapback in some of these yen pairs that have come off a little bit. Like you take the Aussie yen, for example. The Aussie yen has come off quite a bit. Maybe the New Zealand yen bounces too, and maybe even the Canadian yen, because this is all this news out of Saudi Arabia might be better for crude oil, could be better for the Canadian dollar, and as you can see, the Canadians were right up against some fairly important triangle resistance. This is something that we were monitoring last week. And you can see we're pushing right into what I think is fairly key resistance here for like the Canadian yen. So, we'll have to see if we can actually break. Honestly, I'm not really. Oh shoot, I didn't mean to do that. I'm not really 100% sure for myself what I'm going to be doing with the markets here. I'm on the short side of the U.S. dollar Mexican peso, and we've just rallied back to the previous trend line, the broken trend line, the 38% retracement. So we should pivot here. It should pivot lower around these levels, but I'm not, I'm a little worried that, where equities are at, we might be, signaling a little bit of a reversal here in equities. So, I think we'll see it show up in the dollar Mexican peso first. We should see this turn lower if the stock market's really going to bounce. But if the stock market doesn't bounce, and we can continue to see some downside pressure, I think you're going to see it here in the U.S. dollar Mexican peso first. This will take us right back above 24, and if that happens, then then I'm going to think that the equity markets are probably due for a more sustained pullback. The one thing that does worry me a little bit about equities where we're currently at is everybody's pretty bullish right now, in my opinion, from what I've read. A lot of the reports that I read, people are pretty bullish risk, and everybody's expecting the market to continue higher here after squeezing some of the shorts last week. So I think positioning wise, we're probably a lot more even than we were, a week or two ago. So I don't know. those would be my initial thoughts as far as what the markets are doing. But like I said, I am a little tired today. I woke up late. I'm just kind of getting my head back in the game right now, and yeah, so that's kind of how I feel at this point. I wish I had more to. I wish I had more to add to this. Hold on, really quick. Sorry, we are starting to see this move out of the U.S. dollar Mexican peso. It's actually starting to move pretty good here. We're just moved above resistance, and it looks like we're going to take out this 24 level. I'm guessing here. So Dale, are you even here? I guess no one's here.
Good morning.
I guess it's just me.
Me and you, baby.
Hey, what's up, Stelios? How's it going?
I'm good. I have a terrible hay fever I get it from
What? What?
What?
What'd you say?
Yeah, I get this like hay fever from pollen, but also from the olive trees. And so April and May for me is a disaster.
Oh, the allergy season.
Yeah, it's okay. It's okay.
Allergy season's rough for me too. I know everything's in bloom, so it's a nasty time of year for us here.
Yeah.
But so what do you make of this little pullback that we're seeing in equities this morning?
Well, we were talking about this on Friday, and I said this on the webinar and on the chat room. I think there will be a leg lower. When will it happen? A proper leg lower? Well, when all the or many of the shorts get squeezed, which I think they've really started to get squeezed now, and you can see it on sentiment and positioning. And also when people who think, right, this is it, with the low is in, we have to get in the market when they're all in. And I think we're getting very close to that. So is this the top when we're going to see a protracted move lower? Maybe, it could be. I think we will see it. Is it today? I'm not sure, but I'm positioned pretty much 0% of my portfolio in equities, and I'm waiting way below with some bids and see what happens.
Yeah, it's like I'm kind of convinced right now that I think the market is everybody's gotten kind of bullish up here, and maybe too bullish,
Yep.
right?
Yep.
Good morning, guys. Fear Grid Index, Blake, is more or less in the middle ground. If that counts for something.
Right. So, but that tells you that the market has turned, from decidedly bearish to,
to more or less being, undecided, let's say. Yes.
Yeah, but it took a lot to come back from that extreme bearishness that we were at. It did. So I'm thinking near term, you're probably catching a lot of people a little bit, wrong-footed here, because I think the market's getting a little ahead of itself, getting too bullish at these levels. When you talk about like the S&P, I mean, heck, just if you look at how bearish everybody was as we were coming into this 2,900, and then last week, I think the attitude shifted quite a bit. If we end up making a lower high here, maybe we won't hit that 200-day moving average. I went into this week thinking that we were going to reach higher for risk on too. And one of the other things that I think we need to pay attention to is the entire west wing of the West Wing in the White House might have some exposure to the coronavirus. And Mike Pence, the vice president, he is self-quarantining himself. There's a few cases that have popped up, and I think that is actually starting to concern some people. So.
Yep, that's definitely something to look out for. And let's not forget, a lot of people there are of a certain age, so they're going to be a little bit more vulnerable.
Right. So what are you guys looking at? What are you guys looking at as far as setups go? I know you guys are probably you probably heard what I had to say. I got up a little late this morning. Really not seeing anything for me that's like set up for something for me to do. Although we are seeing some dollar strength, and the dollar strength, usually is a result of some risk off, in my opinion. What are you guys thinking here?
I think it's exactly what you said, and we said this again last week. I think FX is trading very much in line with risk, and you see equities pull back straight away. The dollar strengthens straight away. Commodity currencies weaken. Actually, the Aussie and the Kiwi are down 1% today. So it's I think unfortunately equities are calling the shots here, and unless you have a firm view on equities, everything else gets dragged along with them. And so I don't have a strong conviction on anything at the moment. I'm still short Euro Norway, which everybody will know by now, as I have been for a while. It's been giving me some pretty good carry up until the Norwegian slashed rates last month. And now it's in the money, and it keeps going. And as long as we don't see a huge meltdown in equities like we saw in February, March, then I think this trade is going to continue to do well, because it's it's still at ridiculous levels if you look at fundamentals.
Yeah, but if the stock market does come back under pressure, is
that's the risk. Yeah.
Of bouncing here, or pulling back in the Norwegian krone. I've been looking at this ever since we had this completed this head and shoulder pattern, and I had been expecting a move below support here, but it's the lack of follow through is pretty frustrating. It would be frustrating if I was short the US dollar Norwegian krona right now.
Well, I'll tell you what, I'm looking at this, and this is a pretty big level. I mean, you can see in your chart that support line is big. If it bounces and if it bounces with an equity sell-off, then I think I'm going to cover, and then reshort higher, or at least cover part of it.
Yeah, that makes a lot of sense to me. All right, well, I'm sitting here looking at this US dollar Mexican peso continue to pick up steam, and if this thing gets above 24, you're probably going to see a little bit of a squeeze, and this is going to be a false breakdown, and I think it's important to pay attention to that, because that could actually lead us to a rally into new highs. Whenever you get a false breakdown, a false breakdown is a recipe for a complete reversal, to where false breakdown will lead us to a breakout, and that's something that I think everybody's got to be a little bit of aware of down here. So Steve, I'm gonna pass it over to you a little early today, because I don't like I said, I'm not really up to speed on everything, and I came in a little unprepared, more so than a normal session.
Shame on you. Shame on you.
Shame on you. You're fired.
Yeah, I am.
We'll have to refund everybody for what they paid for the webinar.
Sounds good.
Blake is human.
Yeah.
Of course.
You just proved it. Yeah.
Thank you, Blake. Go get some rest, man.
Feel better, buddy.
I'm going to pass it over to you guys. All right. See you guys. Have a great one.
All right.
Bye-bye, mate.
Actually, speaking of one other thing I wanted to add, speaking of the krona, we had Norway inflation for April, which actually bounced back. So it had been going down on a year-to-year basis from around 2%. It went down to 0.7 last reading, and it was expected to go quite a bit lower. It actually bounced back month on month and year on year. So that's one of the reasons why the krona is performing relatively well today. And it's a good sign, I think, overall. But obviously, one print does not make a trend.
USD NOK still, as you see, has flatlined on this horizontal support area.
Yeah, Euro NOK, USD NOK, both at really pretty big support. I mean, after that,
volatility has really, the average through range has really shrinked also during the past several sessions.
Yeah.
So
the Corona has Corona.
So bottom line, true. I think that it's whatever happens next from here is going to be important for what follows, for at least several days. So we break lower from here, I think we're going to see an acceleration to the downside. We rebound from here, we might see a much bigger rebound. I would still favor obviously the downside, as you mentioned yourself, from a fundamental perspective, and I've said it myself many times, NOK is one of the fiat currencies that I would feel much more comfortable holding over a period of time than the vast majority of the rest. So it is what it is.
Yeah. Yes.
What else did we have, mate?
Yes. Well, Blake mentioned it. The Saudis, the energy minister, said that they are aiming to provide more cuts, voluntary cuts, to support the stability of the oil markets. And if people have been listening to this webinar and have members who have been in the chat room, what did we say when they first announced the cuts and it was expected? What was expected? 10 million, and they gave us 9 point something, right?
Yeah.
And we said, look, this is going to be the first trial balloon. This is what they're throwing out there. They see how the oil market goes, and then they're going to eventually do more and more. Exactly the same way as the Fed, the US Treasury was announcing the measures to stimulate the US economy. They started with 200 billion, then it went all the way up to 5 trillion or whatever it is. So I think that's what they will continue to do, because nobody wants oil to be trading at these levels. Not even the Saudis, who are the ones who can weather the storm better than everybody else, and they can sit there and watch everybody else go bust, especially the US shale producers who already are closing down. But even they don't want to give away their precious commodity, which is finite, by the way, for people who don't realize that, cheaply. So this is the main, this is what's been pushing the oil market a little bit higher. Not a lot, but we gained like $1 within a couple of minutes, and that's what happened on that side. We also had the Chinese they said they're going to use more powerful policies to counter the economic problems that arise from coronavirus. So we are, all in all,
does that mean more false accounting? What exactly does that mean?
Translated as you want, but the bottom line is that every single country in the world, or pretty much, is just throwing everything at it, because the effects are going to be big, and unfortunately, I think they're going to be lasting. So, that's something to keep in mind. And this is one of the main reasons why I think equities eventually are going to hit new all-time highs. Just going to continue going, because we're going to see asset price inflation in nominal terms go higher. It has to. But
Indeed.
Apart from that, it's been pretty quiet. We had Italian industrial production for March, not even April, for March, and it was down 30% roughly year on year. So that's a scary reading. Yeah, I mean it's going to be not a one-off, but it's going to be 2 or 3 months, and then hopefully the reading is going to go back to relative normality. But obviously, you don't know that until it materializes.
I doubt it. We're going to have some sharp rebounds when the economies open up. There's no question about it. Yeah. Now, there are going to be rebounds to, in my opinion, to a certainly decreased, capacity than we had, pre-coronavirus. So I think that we might see some more euphoria when we start seeing all the economic indices rebound. Yeah. But I think there's going to be, some risk of move when the market realizes that, yes, we are seeing sharp rebounds, because, that's the only way you can go once you go from a economy that's in lockdown to an economy that is, somewhat functioning. But when they realize that the new numbers are going to be stabilized at, severely decreased levels, I think that they will have to rethink of their expectations for the future. Yeah, I agree with that. Otherwise, I really don't have that much else to say, I'm afraid. I'm a bit like Blake. It's been quiet. I'm just looking at equities at the moment. That's the main driver. It's not a surprise, Stelios. I mean, just look at the dollar index, for example. And we see the same in equity indices, not the same type of pattern, but I'm going to explain what I mean. We had a period that, volatility definitely exploded. We had sharp moves, and the direction was more or less clear for obvious reasons. And now we have a situation where volatility is shrinking once again, but FX has been really stuck due to what the dollar is doing, which is oscillating in a range and nothing else. I mean, this is a triangle, and that's the main reason why so many of the mainstream, especially FX currencies, are doing the same, either consolidating in a range or in a triangle. I mean, take the example of Euro USD. Once again, for one more week, stuck. Last week, I mean, because we just started this week between 1075 to 110, so a rather tight range which we're oscillating within. Here is the cable. The cable is threatening with a breakdown if this is head and shoulders formation, but in order for us to confirm something like that, we would need to see a daily close below 122.50. Until that happens, it's just range trading here as well. USD CAD, a lot of people have been paying attention to the USD CAD, expecting a breakout, but USD CAD is spending more and more time consolidating. You want to look at it as a triangle. You want to focus more on the more recent range and look at it as a rectangle, which is like between 142.70 and 138.70. So many currency pairs are really stuck. I mean, they on occasion produce some big candles in one direction or the other, but bottom line, there is no breakout. So a lot of people are trying to, chase after these, thinking that, they're going to be moving again, and they've started moving again, and then they get disappointed because after a couple of days moving one direction, they stall and they pare back the gains or losses and rinse and repeat. So I do think that this whole situation is going to be resolved. At the same time, by the way, indices, against what fundamental logic would say, keep drifting higher, or anyhow testing the highs. But is there a high conviction that we can move higher? No, it's not easy to convince yourself that they're going to move higher, because economic logic says that they should be a lot lower than they are. On the other hand, you have people thinking, yeah, they should be a lot lower, no question about it. But with central banks throwing trillions and trillions and trillions, I mean, perhaps equity indices can completely defy economic logic, and then you have people trying to play a game that is not easy to play, which is try to figure out how potent is all this monetary lunacy to lifting stocks above economic expectations. So you have to play a guess game. I mean, is it enough to just support them from not collapsing? Is it more than that? Is it enough to push them to all-time highs? Is it enough to keep them in a range? I mean, all of that is speculation. We'll have to find out, because now it's a guessing game of how if what they've already done is enough, and if not, how much more are they willing to do, and if that is going to be enough. So nobody wants to take like a big risk in buying equities at all-time highs, at least not yet. At the other hand, very few are willing to bet against the Fed. So we have this situation where things aren't really moving. I mean, they seem to be moving on a daily basis, one direction or the other, but in essence, they're ending up not going anywhere. So based on that, what we can say once again is that one way or another, valuations are at all-time highs having to do with equities, because we're not at all-time highs having to do with prices, but earnings expectations have really collapsed. So equities are more expensive than they were 3 months ago. Also, even if that was not the case, the rebound has already, moved the market quite a lot in quite a short period of time. So risk reward in the short to medium term seems to be very bad if you want to be long at current levels. Now, if we pull back from here, we could reassess. But currently risk reward doesn't look that healthy in being long. That doesn't mean that equities can't move higher than what they are. But if you're asking me if I believe they can go to new highs just by following this, for example, ascending channel, I think they can't. I think there should be at least a decent leg lower again before even that could be a possibility. Now, as long as the situation is what it is with equities, it's not going to be easy for pairs that are very highly correlated with risk, like the Aussie, like the Kiwi, especially the Aussie yen and the Kiwi yen, to really get going. So what I said about equities before applies here as well, meaning we've had a very decent correction so far. This is the Aussie USD, for example. But it's more than clear that momentum has waned. People are not finding it easy to buy it up here without seeing a decent pullback, because everybody's thinking like, okay, it's very likely that risk is going to take another leg lower, and if that's the case, I know very well that being long the Aussie is not going to be the place to be. So I think we've got to the part that a lot of people are looking positively in owning some of these commodity currencies, but not many are willing to own them at current prices before we see a pullback. So, I think that's the case here as well, meaning, can we have formed a double top here in the Aussie in the near term? Yeah, that might be the case. Of course, we would need to see a move below 63.80 to confirm such a case. In any case, 62.50 I think is a decent area of support we can look towards. Here's the Kiwi, more or less the same situation, different type of pattern, but still I would call it a corrective pattern. I mean, this looks like a wedge to me, obviously. So a lower low, meaning a move below 60 cents, I think is going to open up more downside. Aussie yen broke through this wedge. It looked textbook. We then rebounded, and so far today we are being rejected once again from the same area of resistance, the 61.8 of that last move lower. Also the potential of a double top here, of course. That would be the case, having to do the double top only if we move below 67.50. That would trigger such a double top. Up until that point, the only thing we have for the time being is another rejection from the 61.8. Definitely the risk reward would favor short positions from here, because you're risking very, very little with the potential to make more. Kiwi yen, a little bit of a different formation, but I would still characterize this as a continuation formation. It's a triangle getting rejected once again from the triangle trendline resistance. As long as we are below 66.50, which was also the gap area, I do think that risk reward would favor short positions. In any case, to summarize, I do think that commodity currencies are vulnerable at current levels, at least in the short term, and stock indices are also vulnerable at current levels. That doesn't mean they can't move even higher initially, but I do think that the risk reward is totally skewed to the downside after having rebounded so much, with the economic reality being so much decoupled from what we're currently pricing in. We're currently seeing valuations equivalent to the dot-com bubble in many cases, with the global economy being at least partially shut down, and with anybody that understanding economics realizing that you can shut down an economy with the flick of a switch, but the opposite doesn't apply. I mean, you can't just flip a switch and restart an economy and get economic activity back to where it was. There are many, many reasons why that isn't the case. Psychology and human behavior, as always, that's why economics is a social science, offers the best explanation. Meaning, let's say that you were, let's take the US as an example. Let's say that you were one of the 30 million people that were laid off Okay, no matter how optimistic you were, that you know, once the economy restarted, you would get your job back exactly like nothing ever happened before. But you know, at the very least, as a human emotion, you would be worried, right? Meaning that even if that was the case, even if they initially called you back to give you your job, at least for a period of time, you would be a lot more careful with your spending, thinking that, okay, what if things don't go 100% back to normal? So, you know, this is how it works, and that's how it also becomes a self-fulfilling prophecy, right? Because once people start becoming a lot more cautious, and we very well know that the vast majority of the developed economies are based, unfortunately, because it's a very flawed economic model, on the concept that consumer can keep an economy going just by spending money, majority of which is coming from credit. You know, the consumer will hold up the economy, but the consumer, once things start looking, you know, not so rosy, at the very least is going to refrain from taking any more credit, is going to refrain from going through part of what we call discretionary spending. So, you know, the consumer is going to hold back on that. And that on itself is going to decrease economic activity. And guess what? Yes, that's going to keep unemployment higher, etc. Pair that with many mistakes that have been happening, you know, because political choices, we've said that before. I mean, good politics is bad economics usually, and good economics is usually bad politics, meaning, you know, politicians want to, you know, show solidarity to people that have been hurt by the economic shutdown, which, you know, from a human emotion, it's understandable. But on the other hand, for example, offering people more money not to work than they made working is something that the only thing is going to do is give incentive to people not to go back to work. So, you know, that's also not going to help, with along with other things. Now, having said that, we have a question, by the way, having to do with Bitcoin, and the reason I'm gonna mention it. There we go. We had quite a big crash for Bitcoin prices. It was on Saturday, if I remember right. Sunday, early Sunday. So we had like a 20% crash at some point. So there are a lot of people that are wondering. First of all, we said that before. Cryptocurrencies are digital risk. Okay, so you know, you want to have, you know, small part in a portfolio being cryptocurrencies. I understand, because, you know, there is limited downside if it's a small part, and, you know, if they really overperform, they can help your portfolio, you know, improve its performance. But, you know, really, if you want to own assets like Bitcoin, Ethereum, and the rest of the cryptocurrencies, you know, you need to be ready for that type of volatility, which, you know, doesn't make much sense if you ask me. That's why I would pick, you know, gold over any cryptocurrency at any given point. And you know, it is what it is. Regardless, Bitcoin is still holding this ascending channel. During the flash crash that we had, like within 5 minutes, 10 minutes or so, we had that move lower. We retested, we back tested the confluence of the 200 daily moving average and this ascending channel trend line support, and so far it's holding. So that's positive, right? Ethereum, more or less the same situation here. We came back. We're currently retesting this ascending channel trend line support. So bottom line, they flash crashed, but from a technical perspective, they're still not broken. Okay, so you know, that's the bottom line here. Now, there are a lot of people that are seeing this whole period in Bitcoin like a huge type of, you know, triangle or something like that. So they believe, and from a technical perspective, it does make some sense, right? That if we cross through this trend line resistance, then we're going to see, a huge move higher and an acceleration higher, perhaps to new all-time highs. I remain a lot more skeptical, obviously. I mean, I do believe that with all the monetary and fiscal lunacy that's going around, governments in essence are doing their best to push people in alternative assets, cryptocurrencies being one of them. So that definitely helps in some extent, but I remain a lot more skeptical. In any case, as long as Bitcoin, for example, remains above 8,000, that confluence of supports we showed before, from a technical perspective, it's still looking okay, right? Most people have already had their hours cut in UK from 40 to 25, says Jane. Yeah, makes sense. Gold, silver, oil, natural gas. Yeah, let's have a look at all of those. So, nothing has changed here in gold. I mean, can't get more clear. This is a triangle, right? This is a consolidation in a triangle. Triangles in the vast majority of the cases are continuation formations, meaning, I favor a breakout to the upside a lot more than one to the downside from here. Upside targets following such a breakout would be 1771, 1821, 1859, 1920. I call them in order. So, that's what I think. As long as we remain in this triangle, the path of least resistance is higher. If that is an indication, silver has already broken out from the equivalent triangle. Now, so far, the move higher after breaking out isn't impressive in any way, but that's still the case. 1598, the 61.8% fib, is the next upside resistance for silver, with 1650 following that. So I think that both of those monetary metals, they're still looking good. I mean, nothing to really write home about, but definitely there is no technical argument yet for calling them to reverse lower. I know that a lot of people are looking for something like that to happen, and it might, but for the time being, there is nothing bearish that you can distinguish on this chart. So in my opinion, don't try to fight them. Now, natural gas got rejected from the 200 daily moving average. Backtesting the 50 daily moving average. Let's see if it can post another higher low, because it has, already posted 3 of those. So let's see if it's going to find support here. If that's the case, would make sense to expect even higher levels from crude. Crude is stubbornly here on its 5th day, retesting this confluence of resistance is roughly at $20. This is the continuous, by the way, and I'd rather plot on this for reasons I've explained in the past. It still looks very decently bid, and I do think that if we break above 20, crude should squeeze higher from here. So from a risk reward perspective, it would make sense if you want to be short, just because we're very, very close to a confluence of resistances. But if we break through 20, I think it's a very unwise decision to be on the short side, because we can really squeeze higher. I think we can be at 25 within a matter of 3-4 days. So, doesn't look that much of a move, $5. But if you consider starting from $20, right, that's a 25% move higher. So, that's not a negligible move you want to bet against. So that's what I think about crude. Copper, barometer, another barometer for the economy. I see the same that we saw in the vast majority of commodity currencies and risk assets. I see a decent rebound, but in my opinion, has corrective characteristics. As long as we stay below 248, I think that there's a big danger that copper is going to fail. and turn decisively lower. So I would be very, very careful here, because I think that copper can really suffer in the days and weeks ahead if risk assets take a tumble. And in any case, as I said, 248 is a key resistance area. So, you know, the closer we are to that, the less it makes sense to want to be long copper. Hi, when you have time, could you speak more about the mental aspect? The trade Friday inactive trade was closed, but the idea was strong as you had also was yen. So you try again to short it or you hedge it, or how you decide what you do in these cases. The question is a little bit not phrased correctly, so I'm not sure exactly what you're asking me here, having to do with the Aussie mental aspect, but then I lose the train of thought with the rest. Trade Friday, inactive trade was closed, but the idea was strong. Some letters missing also, which are not helping. How do you decide on the amount of each trade? If smaller, okay, I can answer the last one because it's more clear. You know, I have a set position size, and based on conviction, I decide how much of that I want to trade. Usually under normal circumstances, I'm going to trade a full position, or I'm going to scale in a full position, but I have to adjust that based on a couple of things. One, as I already mentioned, is conviction. The second one is circumstances, because if I want to scale in a trade because I'm not very certain about, I'm certain about a direction change, but I'm uncertain about, you know, what's going to be the key level, I'm scaling in, and in some occasion that means that scaling in, you don't get the ability to build a full position even if you have the intentions to do so. So sometimes you end up with, you know, less than a full position, although that was not your intention. And another factor which is crucial, obviously, is volatility. So for example, you know, if I want to trade the Euro Swiss, I'm going to give two extreme examples, right? If I want to trade the Euro Swiss, which is moving, you know, marginally on an average day, I might actually take 3 or 4 times my regular size position for it to make sense and matter. Another extreme example is if I want to trade crude oil at a period, for example, where it might be producing 10% moves on a day, or Bitcoin, for example, I might take 1/3 of my regular position. So, you know, the two main aspects that affect my position size are those two. Now, having to do with what I mentioned before with conviction, I just want to make, I just want to clarify something. I just don't want to leave that to, you know, to misinterpretation, open to misinterpretation. When I say conviction, I don't mean like, you know, I might go on a trade being like, you know, who knows, this might work. Because if that's the case, I don't want to go in a trade at all, right? So by conviction, I mean relative conviction. But in order for me to go in a trade, I need to be feeling really good about it. But even with putting like a minimum barrier of feeling very good about it, there is still a scale for what lies above. I mean, you might feel fantastic about a trade or very good about it. You know what I mean? So, you know, if I feel amazingly, you know, convinced about something, I feel like, you know, I can go to bed and wake up and not even care to watch what it did because I'm so convinced, which it can happen on occasion. You know, I might move in a full position a lot sooner.
Tell
Or
the Steve, tell the attendees what gives you that feeling
what do you
when
mean?
you feel good about a trade. What lines up for you to give you that conviction?
It's not 100% objective, and I'll explain why. Because, for example, from, you know, you do some technical analysis. First of all, as a general rule, if I wanted to answer that, I feel amazingly confident about something if my technical analysis agrees in direction with my fundamental analysis, because I feel much more relaxed when I take a trade in the position, in the direction, sorry, that I believe that it should also eventually move fundamentally.
Okay.
So that is definitely something that affects how I view it. Now, on the other hand, it has to do with confluences. So, for example,
Bingo.
the more confluences I have showing me something, the easier I feel about it. So if I'm like super lucky and they have like 3-4 key confluences telling me that, okay, you know, if we get rejected from there, you know, that's a perfect point you want to be involved in this market, and I see this to start working, then I feel, you know, very confident, right?
So the more evidence you have,
Yes.
the stronger the case. It's like a
Yes.
legal argument.
Exactly. So exactly.
I knew that, but I wanted you to tell everyone.
It's also sometimes, and you know, the more experienced you become, it sounds funny because it sounds counterintuitive. If you're not involved with it, you would think that the exact opposite would apply. But I'll tell you something that is important. The more experienced you become, the more you get to trust your gut feeling. Meaning you don't take decisions based on your gut feeling alone in any, you know, in no way you let yourself do that. But since after some point you realize that your gut feeling is more or less your mind's method of perhaps creating some emotions based
That's what
on
Blake is trading on today, his gut feelings with his cooking from last night.
so when your gut feeling makes you feel very confident about something, many times I've noticed that perhaps it's your subconscious method of telling you that perhaps there is even more evidence than you've consciously interpreted. You know what I mean? So
Sure, I do.
so I've got to trust my gut feeling more. So when my gut feeling makes me feel more confident with something I've already planned, then in other cases, that also helps a lot. So, you know, these are the basic rules of thumb. But, you know, it's trial and error quite a lot. And, you know, if you spend time surviving the markets, then doing well becomes a little bit easier, you know, by the month. Question about the FTSE. Yeah, we can have a look at the FTSE and here's the FTSE, by the way, and the DAX. So we're going to have a look at both of them. So the FTSE, here it is. Now, my initial interpretation here, which from a technical perspective looked perfect, right, was that this is an ascending wedge, a pennant, right? A continuation formation. You can see it clearly here. And we even had a little bit of an overthrow, which is perfect because that's a very frequent behavior from such formations. You get a little bit of an overthrow. Usually that's when weak hands capitulate. And then we had this big daily reversal. I mean, that's a beautiful outside black candle that we had here. And, you know, bottom line, as long as we're not invalidating this reversal day, I think that the path of least resistance remains lower. Okay, so
quite a bit of relative weakness compared to the U.S. index.
Oh yeah, absolutely. Especially, you want to add one more factor here, Dale. It shows relative weakness despite the cable being under pressure during the past few days. Yeah. So even with the currency somewhat helping, it's not performing well. So I also believe what you just said, that the FTSE looks probably one of the most vulnerable of the stock indices that I'm currently monitoring. And from a risk reward perspective, I mean, we touched 6,000 earlier today. The high was at 6,200. I think, you know, any type of trade like that, from a risk reward perspective, it makes 100% sense, because at the very least, even if this is a corrective move, At the very least, let's now delete all that. At the very least, I would expect one more leg lower, even if this is a corrective move before higher. Needless to say that there is a very big chance that this is actually what's going to happen. We're going to see a continuation and not just a corrective pullback. But even if this is a corrective pullback, I think that from a risk reward perspective, it makes sense to look lower from here for at least one more leg, I would say towards 5,600, something like that. Okay, so that's what I think about the FTSE. Thank you. I shorted at 6,000. Yeah, that's quite a nice level. That's quite a nice level you got yourself there. So I think stop loss above 6.2K. I mean, you're risking very little, and even if we make it down to 5.6K, you'll have made, you know, twice as much as you risk to lose, which is, you know, in my book, it's a very nice trade. Aussie CAD was leading the Aussie pairs higher. Maybe it's now leading on the downside. Let's have a look at it. Here it is. So the Aussie CAD has definitely stalled at current levels. Has it reversed lower? Not yet. So, you know, this 91.50 area is a key resistance area. You can see it if we, you know, if we go back. But so far we only have a consolidation. In order for me to start looking lower, I want to see a move below 90 cents. If we do get that, I think that we're easily going to move back towards 88.50. So we're easily going to see another 150 pips to the downside. And then the pair can decide if that was a corrective rebound, which is failing, or something different. Definitely, you know, one thing is for sure, I wouldn't be buying it up here. But at the other, you know, on the other hand, you know, you don't yet have evidence you should be selling it. So I think the next few days are going to shape that up. And as I said, below 90 cents, you can then look for another 150 pips to the downside before deciding what you're going to do. You know, not of my favorite things to trade, I have to admit. But in any case, good luck with that. Spain. Dale, do we have an interview today?
Yeah, Peter Goldstein.
Oh, is he here?
Yes, he is.
Oh, okay. Okay. Then go ahead and start the interview. IBEX, you
Go
can
ahead.
see a pennant as well here. I mean, looks very bearish to me, bottom line. So impulsive move lower, pennant, and I think, you know, it's in big danger of breaking down. As you see, it looks very similar to the FTSE, even worse actually.
It does.
Likely. Yeah. So
Yeah.
bottom line, if you want to be short the IBEX, I totally get it. But if you want to be long the IBEX, I mean, there are a lot more indices that look much better than the IBEX does. So, you know, you want to be long risk, I think you'd better pick something that looks somewhat better than this because it looks really, really vulnerable.
And
Okay,
the
thank you,
pain
Dale.
in Spain falls mainly on the plane.
Oh, the pain in Spain and, you know, in all
Falls
those
mainly on the
countries
plane. That used to be the rain in Spain.
is going to be huge because of many reasons. Main
Yeah.
reason being that, you know, all these European countries, Spain, Italy, Portugal, Greece, have already had a very bad period of like 10, 12 years. Economy is very fatigued after a huge period of contraction and restructuring. People probably have very little patience left, so the social situation might, you know, unravel much faster than many would expect. So in any case, you know, I would be very careful with these economies.
Thank you, buddy. All
My
right,
pleasure.
Peter Goldstein. I just unmuted you, buddy. Welcome back to Face. How are you, Peter? Do you remember how to use this? Peter Ghostbuster. Paging Peter Ghostbuster. I don't hear you. Your fans are waiting for you. Be Vic Pandy.
First of all, if he can hear us, he should first of all type something, so I know he can.
I hit the unmute, and it still shows his mic. Oh, there we go. Hi, Peter. No? He's ghosting.
Perhaps he needs to choose the right audio source.
Yeah. What are you using for audio, buddy?
Yeah, but for the time being, I want to see some kind of an acknowledgement that at least he can hear us.
Yeah, can you type into chat? Oh, here we go. Intelligence gathering. We need your voice.
Yeah,
Peter?
we can see your screen, Peter, but we cannot hear your voice.
Test.
Yeah, there we go.
All right.
Yeah.
Awesome.
All right. Okay. Hey, Peter, how are you?
Not bad. How about you?
Okay, I'm doing good. I was really looking forward to talking to you today because, you know, the big debate now in the market is, was that a low? A lot of people starting to believe that. So I'm wondering where your head is at on, and I know you do a lot of sector stuff too. So I'm just going to let you talk and try not to interrupt you because your work is excellent. Go ahead, buddy.
Thank you, sir, and thanks for having me this morning.
Great to have you.
The short answer to whether the low was the low, I firmly believe it was. But from here, I see one of two potential paths that the S&P 500 and the market in general will take, and it all depends on whether the reopening of the economy will succeed against all odds, and whether we'll have in time or ahead of the potential second wave, not that the first wave is over, but since they're forecasting a second wave in the fall, and America being America, will we surprise by having therapeutics in time for that, and potentially a vaccine like Pfizer assures us they will as soon as October.
Wow.
So I want to start with valuation for a minute using my valuation model. Jeremy Siegel on Friday had an interview, a very enlightening interview. And one of the takeaways is what he said about the value of stocks. He says more than 90% of the value of stocks is from earnings more than 12 months in the future. And I agreed with him because look at my valuation model here. I have 12 lines right here, starting January 31st, week over week. I've been plotting the forward S&P prices for Q2 2020 through Q4 2021. Now, late January, everything was, you know, nice and dandy. We weren't gonna be subjected to what China was experiencing. Actually, there was hardly any talk about the coronavirus. It's just a transient event.
Right.
But the S&P 500 was trading at Q1 2021 and Q2 2021 valuations, 3,315 to almost 3,400, meaning they were pricing in earnings 12 months forward, at least actually 12 to 15 months forward. Now, enter May 2021. We had that black swan event. We dropped all the way down to 2,200, a little less than that. And we basically erased the entire Trump rally, if that's what you want to call it.
Yeah.
We actually traded down to what earnings are telling us today, forward earnings for Q3 and Q4 2020, meaning we're still in Q2. So September 2020 and December 2020, fair value is down where we were in March and early April. Actually, March, because April, of course, we recovered. So we've already had the counter reaction to where we were in January and February. We had an equal and opposite reaction because based on 2019 earnings, which were about 140 a share, multiply that by a PE of 20, historical PE of average of 20, you get to 2,800. That's why over the last 2-3 weeks, we've been hovering or meandering around that 2,800 area, right? And in fact, the first leg down in March was down to where? 2,800. Right. So that was fair value. We dropped below fair value and we had an equal and opposite reaction, meaning we traded 22% above fair value in February. And in March, we dropped down to minus 22% relative to fair value. Okay?
Yeah, interesting.
Now, here's the thing. Right now, the S&P
was like mean reversion.
Exactly. Actually, we mean reverted to 2019 fair value, and then we did the opposite.
Yeah.
From greed to fear, right, going through fair value. So now, my original assumption was that we're going to mean revert to about 2,800. But then you have unprecedented liquidity on the part of the Fed. And stocks, as Jeremy Siegel said, always look or price in 12 months or more of earnings. So actually, we're doing more than that because right now we're in Q2 2020. As of May 1st, based on the forward earnings estimates, Q2 2021 would have been 2650. We're trading as of now, we're pricing in all of Q4 2021. In other words, the entire 2021 estimates, they're priced in. One caveat though, week over week, the forward estimates are improving. That's why you're seeing the blue line crossing over the red line. And I don't have
constructive when it's
constructive.
Above the red.
Yes, because what's happening is last week or 2 weeks ago, the forward estimates for Q2, Q3, Q4 2021 were the red line. Now they're improving. So the forward price estimate for the S&P as of for Q4 2021 is 3,000. So they're pricing in everything already, and that's the troublesome thing. But however, if week over week that blue line or the next line for next week will be above the blue line, then they're going to keep chasing that because, as Jeremy Siegel said, we're looking ahead 12 months or more. But here's the trouble. Here's the ES, the S&P continuous contracts. We had an ABC decline, the S&P decline in ABC fashion, traced out an inverse head and shoulders bottom that has a measured objective of about 3,100. That 3,100 is in the span of the B wave, towards the top of the B wave, okay? So there's something else also. If you look at the same chart, I have the DeMark indicator here. We had a bearish price flip after that B wave ended. And I think that's when we had our interview, right about that time. We had a bearish price flip, and technically,
I think it was a day after. Is this a daily chart?
This is a daily chart.
Yeah, because you said I think there was that gap told you to get out of the way the next day.
Okay, exactly.
That's so what you said.
Right.
See, I mean, I remember everything people say at every interview.
I appreciate you reminding me of that because I forgot what I said. But
okay.
That bearish price.
What's your name again?
Yeah.
All right, just kidding.
I know what I'm driving though. and who the previous owner of the car is.
All right.
So that bearish price flip is when the closing
Yeah.
price exceeds to the downside the closing price 4 days earlier. So we closed below the closing price of that green bar, and we went on to make a minimum of 9 consecutive closes each below the closing price 4 bars earlier. So the trend was definitely down. And suddenly we had a bullish price flip, a green bar that basically reversed the work that the last 4 red bars did. Okay.
Yeah.
And from there on, we rallied, had a bullish price flip again here, and we went on to make 9 consecutive closes above the close 4 bars earlier.
Right.
So we had that. So again, it seems that
2400 was big.
right. So we're progressing towards that resistance zone, which is TDST, by the way, is another indicator. It's the top of the bar that printed that bearish price flip. So that's 30.37. The top of the B wave is about 31.30, 31.37, according to this. Yeah, that's this red bar, the high. That's when we reacted to the first intervention, the Fed intervention, that they did the first rate cut. I don't know how much it was. I don't recall. And then everybody sold into it, and we did. And then, of course, the next leg was much bigger than the first one. So TDST 30.37 and then 31.37, that is the danger zone. And by the way, we are down today. I'll explain why in a minute. Here's the trouble with this, okay, from a valuation perspective. If we get to 30.37, 31.37, we'll be trading at a PE relative to trading 4-quarter earnings, which as of today, they're about 125, 126. So if you multiply 125 to 120, they're exactly, as of May 1st, they were 125.55. So my model tells you that, or suggests that every time the PE reaches 24 or higher, we are in the danger zone. We're liable to have a precipitous decline. Whether this will happen this time around, in light of the fact that we are in a liquidity-driven situation, and also we have earnings and the market, and not earnings, I'm talking about presidential elections coming up, and we have a market that's hopeful that we've dodged the bullet. So there's a lot of hope riding on this. But again, if we reach that zone, we're already trading at above 23% PE. If we reach 24 to 25, this is where the biggest moves down began from. So that is the danger that I'm seeing.
Okay.
Now, forecast. Here's my forecast that the low for blue wave 4 is in place. Okay. Whether we retest it, whether we move sideways for several months, I personally believe, firmly so, I'm a firm believer that the 4th wave of the super cycle, and look how much work I've done here. I haven't shown this chart before.
Yeah, you go back to when I was born,
Yeah, almost.
1871.
Right. So I go back to when there was actual data, and some of that data wasn't even S&P 500, because pre-1957 you have the S&P 30, the predecessor, and then you have data from an economist by the name of Alfred Coles. So
I knew him.
You knew him, huh? You went to school with
We had
him.
a couple beers together.
Anyways, here's my super cycle. You're funny, then. It's a good way to start the week with a little bit of humor.
All right. Well, it's tonic. So that's it then, Peter. I mean, 4, and maybe I see you have some squiggly lines off the 4.
Yeah, because I don't know what's going to happen here.
Yeah,
you can have another wave, and the market can take 2 different. That's why I'm talking about 2 different possibilities. So you have wave 1, and then you had the .com bubble burst, failed double top, and a retest that was a sideways move. I call this, of course, and explain it to that. That's wave 2, around the 50%, and then you have Wave 3, a little less than 50%, which is good because when wave 2 exceeds 50%, you're expecting wave 4 to not reach 50%. It's the principle of alternation. So we got just below the fourth wave, the yellow fourth wave, and then we bounced back big time. Now, how fast we're going to get to 5 depends on, again, what's happening with the reopening of the economy, the prospects of having a vaccine, therapeutics, whatever, that would ward off a second wave of that coronavirus. So in the long term, we're all dead. That's my long-term forecast. That's what I'm seeing happen in the next, say, 3 to 5 years. Now, here's the Dow Jones. We talked about this in the last interview, is that I'm expecting it to either stop at the yellow line, or meaning the top of the pitchfork, or continue on down to the 18,000 area to test or back test the blue line. And that's exactly what we got.
Wow.
Okay?
Yeah.
It was incredible when I saw that. And here's the forecast, same exact forecast, slightly different than the S&P. The S&P had a sideways expanded flat. The Dow actually printed its fifth wave in time or right ahead of the financial crisis, came down, tested the fourth wave, that was wave 2. And then wave 2 was about 50%, and so was wave 4. In other words, everything we built up or everything we gained in 10 years, half of it was lost in a matter of 2 weeks. So now, again, my forecast calls for the fifth wave to end somewhere around 36,000, maybe more, depends on what happens. Because, towards the top, you have blow-off tops. You have hysteric moves, basically, to the euphoria. So, again, we'll see what happens. Anyways, the important thing is the SOX. We talked about this a lot because the SOX, semiconductors drive everything. And the reason why I'm excited about the SOX, because you don't let a crisis go to waste. Technology will always offer solutions to problems. One day we might walk into a building and there'll be sensors testing us, measuring temperatures, whatever. You walk through some sensor and it tells you everything about what's going on.
Amazon has those in their warehouses now.
So imagine how much progress, technological progress, because you can never underestimate science and technology. So that's why I'm so excited about what the SOX is doing, because you have this massive cup and handle. And after we broke out of it, that breakout was really fifth wave. So coming down to retest the breakout zone was the least you would expect. And that's exactly what we got. That's why we bounced back so vigorously. So I'm looking for the SOX.
So it's 5 of big 3 in all of these when you have the 5 up there. We ended the third wave. We got a fourth wave pullback, and now we're into 5 of 5.
We're into something. I don't know what that is, because, the SOX it didn't begin at 0. It began 30, 40 years ago. I don't know exactly when, the 80s, maybe. I'm not sure exactly. I forgot when the SOX was constituted. So the only visibility I got is this. I know that it's going higher. Whether this was wave 1, this was wave 2 at the 2009 bottom, and this is wave 3. I don't know. I really don't know. So only the future will reveal what's going on with the wave structure for the SOX. All I know right now is that this big, massive cup and handle has a measured movement of about 2,600. Okay.
So that's plenty of room.
That's 57% higher from here.
Yeah, I know
And-
this is one of your favorite groups too.
Right.
That you love semis.
57%, if you go back to the S&P, where the target I have up there is 48%. So the
Yeah.
stocks will outperform the other indices. Keep that in mind.
Okay.
So short and intermediate, that's what I'm interested in looking at. What path can we possibly take? So let's say that everything works out and the economy reopens and we have vaccines and therapeutics in time to ward off, because remember, without a vaccine, forget it. I mean, they're opening bars and things like that. I heard in South Korea and other places, and they're seeing spikes in the virus. So only a vaccine and effective therapeutics can deal with what's going on. So assuming that we do get the ideal outcome, then what's going on here is a series of wave ones, wave twos, and it's hard to believe that we're in wave 3 right now because of that decline we just saw here, but it's possible. So if we break to new highs, let's say that the late April highs are somehow exceeded by the ES, then we could be back at the highs, and that would be wave 3, the burgundy one or pink.
Yeah.
And then wave 4 would be a handle. Then wave 5 would see us at 36 or 3,700 on the S&P. And you've heard some people talk about the 3,600 target on CNBC recently, more than once actually.
That's where the megaphone upper line comes in.
Yeah, but here's the thing. Those same guys calling for these targets, they were calling also for 3,800 and 3,700 and 4,000, whatever, before we got that bear market. So
that's why I turned the volume down.
Yeah, and the same guys who were calling for those lofty valuation or those lofty targets. When we got down to 2,200, they were calling for 1,700. So exactly, you got to turn the volume down and see what you're seeing.
Learn to depend on no one but yourself.
Right. Now, let's say that we fail. We don't have therapeutics in time. We see a second wave, which would be devastating to the economy. Then this rally, as we approach presidential elections, will probably be target of the inverse head and shoulders, which is about 3,100. Let's say that we end up that whole rally end up being a double zigzag, a counter trend rally. Right now it looks like a V, right? It looks like a V, but it could easily turn out to be something like this. Okay, so the second phase of the bear market is an attempt at retesting the lows, but it might end up being a triangle, a wait and see kind of triangle. Because remember, you have unprecedented liquidity being pumped into the market. So they will provide a backstop for stocks. So you could see a triangle here that would last several months, and this whole thing ends up being a W, not a V. Okay, and a lot of smart people are talking about a W, while the reactionary people are talking about the V. Okay, now, is it the first time that we see a correction ending up in a triangle and ending up at a higher low? No. In fact, if you go back to last year, the market rallied into May 2019, had the first pullback into early June, had a failed breakout, and then ended up tracing out a barrier triangle, an ascending triangle that ended in October. So this whole correction from early May, actually printed new highs, but all in the context of a consolidation that ended in early October. And then we broke out. And if you recall, last time I said a triangle precedes the last move in the direction of the prevailing trend. And then we saw what we saw in February and March. So again,
Nice.
okay, that
Nice
is the other,
presentation.
this is the other possibility.
Yeah.
And before that is, of course, the pipe dream. This one is the pipe dream right now. Okay. So that's why I'm trading on a very short-term basis. Everything I'm doing is short-term. I'm not betting on what's going to happen in 3 years. If you buy Apple now, you're going to be rewarded 2-3 years from now. I don't care for all that. So here's the Nasdaq, by the way. The Nasdaq overnight made a new high, but it ran into the 2020 value area high. If you see it here, the red bar, the red candle hit the value area high and pulled back almost to the VPOC. So, you know, things can change. Things can turn on a dime. One day you have a rally with incredible breadth. The next day, it's like, you know, it's bipolar. It's a bipolar market. So right here, even though the Nasdaq is near the highs and the TDST is really the high, and this looks like it's developing into a V also, we could easily reach 88.6%, maybe not even make a new high before pulling back. In fact, those who think that we're already out of the woods because we're near the highs, I'd like to remind them of 2015, 2016. Summer 2015 decline was then, or set the stage for a rally to a new intraday high. And then guess what? We came back and tested the A, the wave A. That was a running flat. A running flat. B is higher than the starting point of A, and C fell just short of A. Typical running flat. So anything can happen. I can never say to anyone we're out of the woods.
You know, it kind of makes sense, Peter, after that dramatic move, dramatic recovery, that we have 5 months of uncertainty into the election and the fall of sideways movement.
Right.
A battle between the bulls and the bears, because they
Right.
both have arguments until, like you said, there's a vaccine.
Exactly. That's the most important thing. Here's the other thing. I'm not so sure anymore. You know, last time we talked, there was the prospect of a socialist administration
Bernie.
coming in. Remember all that? That's out of the question now. So right now, I don't really think the market cares who gets elected. The market cares about what the Fed is doing, right?
All right. Yeah.
And so I don't think the market is going to react one way or the other to the outcome of the presidential election. That's
a great point. Yeah, that Bernie's out of the picture.
Exactly.
Yeah. And
now the Russell,
go ahead.
if you look at the Russell actually had a great April. The month of April was great for the Russell. It was able to recapture North Territory, the 2-4 line. We got back above that line and above the yellow line, and actually May got off to a good start as well. So we'll see whether this mean reversion can reach 1450. That's where I would expect it to bump into resistance. Okay. So the Russell is recovering, and it should do so if the reopening of the economy works out. You know, all these small businesses and whatever. You know, right now we're sort of in a deflationary environment, despite all that. And we're going to talk about gold in a second, but the economy is closed or semi-closed. If I go out to a car dealership, who do you think is going to get the upper hand? I'm going to walk out with probably whatever price I want. They're dying to sell a car, right? Now, if the economy reopens, all that M1 money, all that liquidity, it's going to have to find a home. So the economy, for however long, I don't know, the wheels of the economy will start turning again. And I don't know what will happen to unemployment. I don't think we'll see 3.5% unemployment anytime soon. Okay, I bet that the S&P, if and when it makes new highs, the unemployment won't be anywhere near 3.5%.
Yeah.
So this is the Russell. It's making headways. We'll see how far it'll go. The banking index. Now, the banks are depressed, whether you look at the Nasdaq Bank Index or the BKX. And the reason is
Yields.
net margin, right? So you have banks that are basically net interest margin. So if you look at net interest margin, you have banks that are loaning money at what? They can't make money in a zero rate environment, but they also have holders of savings accounts and certificate of deposits. They have to pay interest on that. So if their net interest margin is not as favorable as it is when interest rates are higher than zero, then you can't expect banks to do well. So all those guys buying banks and whatever right now, I'm not even looking at banks. So here's what concerns me. You have banks not doing so well. You have the Russell, lagging the S&P 500. And then you have also the transports pretty much near, they've recovered some, but the recovery is nowhere near commensurate to that of the S&P or the Nasdaq. So those types of divergences are very worrisome to me. And remember, those are the types of divergences that precipitated this decline. Because if you look at the transports, we have a classic Dow theory non-confirmation in 2020. The indices were making new highs, yet everybody was ignoring the fact that the transports were still below their 2018 highs. Okay, so that was one of the reasons that I was predicting this decline. So transports now, if the economy reopens, and people start flying again, because the only way people are going to really fly again if there's a vaccine or effective therapeutics. I'm not flying anywhere if you put a gun to my head unless there is a therapeutic or a vaccine. So again, transport, it's not unusual for the transports to lag behind the other sectors. Every rally, every turning point, 2014, 2015, 16, the transports were lagging, but they eventually broke out to new highs, except in 2020. So this could be a case of let's wait for those vaccines, let's wait for the therapeutics, and then if they become available, then the transportation sector should benefit.
Okay.
The other worrisome sign is the breadth of the S&P, the breadth of the S&P as I measure it in terms of the equal weighted relative to the cap weighted. This thing has been on a decline forever because what's propping up the cap weighted are the big names, the mega caps. That's why the S&P 500 equal weighted, which was actually outperforming the cap equal weighted was outperforming the cap weighted up until 2016, 2017. And then from there on, it embarked on a journey down to almost the 2019 lows. So breadth has been on the decline due to the most of the money pouring into the mega caps. They're outperforming everything else. But in recent days, we've seen a consolidation, a range bound, which could end up being the starting point for maybe a reversal, however short-lived that would be in terms of months or whatever. So it's not encouraging at all for me long-term.
Okay, so you presented a lot of bullish stuff at the beginning, and now you're showing the flip side of the coin.
Right, that's the
what do you give the weight? What do you give the weighting to and the bias for?
So remember, the bullish is long term.
Okay.
The intermediate and the short term, I said we could take one of two paths. It could go one way or the other in the short term, depending on therapeutics and whatever. So here's the thing. Junk bonds, they've actually, they had a cataclysmic decline, and then the Fed came with their $2.3 trillion program.
Yeah.
They're right now trading above the late 2018 low. At one time, they had a problem staying above the early 2016 lows, but it seems that they're experiencing a turning point right now. I am long HYG actually.
Oh, interesting. Looking for what? A retrace move?
Well, I'm looking for, I'm long. When I say long term, I'm talking to May or June.
Okay.
Staying above a certain value.
Okay.
Now, here, what's encouraging is the spread, yield spread, IEF over HYG or IEF or over junk. So 7 to 10 year treasury bonds relative to corporate bonds. When the Fed came with their 2.3 trillion program, we saw this huge gap down that reached the 50-day moving average. Then we had a technical bounce. And as of Friday, this ratio dropped below the 50-day, and which is good for stocks because now what this is telling you is that HYG, the price of corporate bonds, is rising faster than the price of treasury bonds, meaning if I'm a company, I can sell bonds at a high price and not have to pay an exorbitant yield for that. So I can borrow. Borrowing credit seems to be favoring stocks as of last Friday. So we'll see if this.
So you think the Fed is sacrificing sovereign performance to get performance out of junk?
I don't know. What do you think?
Well, I don't know. I think that we've taken on a lot more debt that's going to have to be printed. So the sovereigns are, like you just said, are underperforming. Also, one other point, Peter.
Yeah.
The administration talking about canceling the payment of bonds owned by China. I know it's bellicose. It probably wouldn't happen. But, if we keep going tit for tat for China, it wouldn't take much. They wouldn't have to unload their whole treasury portfolio. All they'd have to do is sell a little to cause some type of panic in the bond market.
Right. Yeah. I don't know.
About that at all?
Here's what I'm thinking. I'm thinking that if we're going to pay the piper at some point for all the debt that we're accumulating, it'll probably be the top of the fifth wave from the super cycle fifth wave. Let's go back to this for a second. Where was that?
Okay.
Right here.
Yeah.
The fifth wave. Now, the beauty of all these corrections is that we can always estimate the downside of a fourth wave relative to the size of the third wave, so on and so forth. But if a super cycle reaches a fifth wave, the downside could be anything. I could retrace 61.8%, 50%, 78.6%, 88.6%. The crash, the potential for that crash from the top of the fifth wave, you can never estimate that anymore because you have a completed 5-wave move and the counter or the ensuing bear market could retrace up to 100% of that.
Okay, best guess for how much time the Fed bought us for this move to fifth wave high at your targets.
Exactly.
2023 ballpark, 24, 25.
You know what?
Sense in time.
Somebody taught me, somebody told me recently or asked me, what's the time frame? I said, well, if I were you, I'd start building a bunker now, because I don't know time-wise when that will happen, okay? I would say 5 years, in the next 3 to 5 years.
That will get to the high of wave 5.
Yeah.
Okay.
In this decade.
Okay. All right. That's a fair bet. Okay.
Last thing I want to talk about is gold. I was a little whipsawed by gold recently. And the reason being is I believe that the trade is very crowded. Everybody comes on and says 1,800 and this and that.
Yeah.
And so the thing is, right now it feels that my dollar has a lot of buying power because, there's nothing going on out there. People are dying to do business. So I can go out and buy a car anytime I want for whatever price I want.
Cash is king.
Right.
Yeah.
So, and we talked about this pattern last
Did you
time.
get your $1,200 from the government?
No.
Me
I
either.
haven't seen
Okay.
nothing yet.
Yeah, I know.
And
They don't pay traders, I guess.
you don't think so?
They were supposed to. All
Yeah,
right, so
well-
let's see. All right, so we
So-
got the smiley face here.
So we had the pattern in gold that looks bullish. And, I was betting on it staying above 160 through May 15th expiration. I don't know where it's at right now. I haven't looked. And then I got out of that position because I felt that the trade was way too crowded and maybe my time frame is not long enough. So I was looking at it yesterday and I see what's been happening over the last 2-3 weeks. A triangular consolidation. If you look at this on
isn't this a wave 4 that would imply one more thrust to the upside?
Yeah, and I think that would take us maybe in the 170s, almost 180. Okay. But it would be a wave 4 of not the highest degree. It'll be 1 degree less. In other words, there'll be another wave 4 to follow it of higher degree to form a handle for that cup. So we have a triangle consolidation happening at and around the value area high for 2020. So I don't know whether it got down below 160 today or not, 159 or so. But I feel that once it breaks above last week's high, this should constitute a legitimate breakout, taking us to the highs. And by the way, it's corresponding.
Okay, well, that's what people are talking about, 1800 on the breakout.
So it's coinciding, by the way, with the reopening of the economy, meaning if the market starts to function again, or the economy starts to function again, there's economic activity, then, we could start seeing inflation at some point. 3 to 4%, as Jeremy Siegel was talking about. He's not expecting hyperinflation.
What would be your bear case? Do you have a bear case for gold?
For gold?
Yeah.
Yeah. And by the way, at one time, since we talked, I changed my mind 3 or 4 times on it.
Yeah, it's okay.
And the bear case for gold is that gold has always been a hyperinflation hedge. Okay? Hyperinflation hedge. Because think about it, in 2000, when did they do the QE3? Was it 2013? QE3? I don't recall exactly. But if you recall, when they did QE3, the gold made a lower high. And then despite that QE3, it went on to lose almost half of its value from 1900 or 1800 down to 1000 or 1100. So it was an incredible, bear market in the last 7 years. And despite all the zero interest rates, and we never saw inflation. In fact, there were.
You have a bearish technical argument for it?
Yeah, the bearish tactical argument is a double zigzag that has yet to complete. And
which would mean what?
So let me see. Let me see if I want to bring up my.
And then I want you to give people information on how they could follow you and keep in touch with you.
Absolutely. So if you see here, we had an ABC, XABC. At one time, last month, I felt that this C wave right here is really the 5th wave of A. And I can make a case for that, which means that this right here is B and C is coming.
That's what I think.
Okay. And
all right.
So that's why I'm out of the gold trade.
Yeah.
Until it breaks above last week's high, then I'm willing to take a shot.
Okay.
But if it drops below this triangle,
if the breakout
ends up being to the downside, then I'll start, if this breaks down, then this value area high is going to fail and we're going to head back down. Okay. And here's the thing. I felt that every single rally in gold in recent weeks was force. It felt forced, like a technical move, because people see, the gold doesn't want to rally. It seems that it's doing it despite itself, and that's what is worrisome about it. Unless a lot of money flow. There's been a lot of flow into gold, and the trade was so crowded, and everybody was front running it ahead of what they're expecting to see happen. And the consensus is 180. And guess what happens to consensus?
Yeah, either never gets there or blows through it. Yeah,
exactly. And in a nutshell, that's all I got. I hope it was.
Well, you had plenty, man.
I appreciate
it.
that.
And really a great presentation. You're getting comments. Rick said, very good guess, nice work in charts. Clear, shows both sides, cause and effect, without pushing bias of market direction.
Absolutely. Very much appreciated.
FX trader, great. Elliotician. Okay. So anyway, great work from Scott Henderson. Thank you for edifying the FACE community today, my trading warrior brother.
Thank you so much for having me. I look forward to talking to you again.
Okay. So is your Twitter handle the best place for people to follow you, Peter?
Yeah. Peter Ghosteen, at Peter Ghosteen. I should have had a slide here with my information, but it's first name, last name. It's that simple. And
all right, well,
much appreciated. And
yeah, we'll set up a date later today for sometime in the summer and keep this narrative going. Okay, buddy?
Sounds great. Good luck and thank you.
So everyone, my trading warrior brother, Peter Ghosteen, can follow him at Peter Ghosteen on Twitter. That's a wrap, and see everyone for Turnaround Tuesday. Here at Peter Ghosteen, you're welcome, Tian, and I'll see everyone tomorrow. Don't just count your pips, count your blessings. Adios.